Welcome here to another Tower Talks. Tarek has an idea that we should start a series of practical, long shelf life videos that will maybe be useful for planning our own financial scenarios. And so we're going to start out this time with a conversation about income splitting. And then we're going to go toward a few other ideas that, we're going to drop down some videos in the future that we hope you'll find practical and useful. So anyway, Tarek, he's got some new headphones. It looks like it's wintertime in Medicine Hat. Got earmuffs on.
Yeah.
So I hope you can hear us. I hope everybody can hear you. Over to you, Tarek.
Yes. Perfect. Thank you. So we're talking income splitting, really, really important retirement planning technique. And let's start with some simple definitions. So the concept is income splitting in retirement, but it's helpful to understand it's because of our progressive tax system. If two individuals who are part of a family make 50 grand a year, federally, they will pay taxes at 14.5% each. Okay. So that's a household income of 100 grand still, each person paying taxes at 14.5%. But if there's the same household, one individual makes 100 grand and the other individual makes zero, their tax rate actually jumps up to 17%. And you say, why is that? Well, that's because we have a progressive tax system. If you make more, you pay more. So on the first 57 grand of income, you pay 14.5%. On the next, roughly 60 grand or 40 grand of income, you pay 20.5. So what we're trying to do with income splitting is keep everybody in the lowest tax bracket possible. We're good financial planners. We want you to pay as little taxes as possible. Okay. Now, when we say income splitting, we also are basically trying to say asset splitting. So in retirement, you want to be able to make sure you have income for each spouse as opposed to all of the retirement savings accruing to one spouse. So they're forced to draw down a larger amount, moving them up into a higher tax bracket. Does that
Okay,
make
so
sense?
one question would be, are the RSPs the same size? That's the
Well,
goal.
if you can make them the same size, that's ideal. Absolutely.
Okay. Okay.
Now, where the way that's practically applied today is oftentimes, well, the situation that made me think of this particular solution is, I had a client, or we have clients who, both make good income, but then one spouse all of a sudden say, hey, I'm making a lot more income this year and going forward. Should I be increasing my RSP contributions for retirement and to offset the taxes I'm going to have to pay? And it wasn't that simple. He's got the right idea in mind. What he needs to do, though, is instead of contributing that to his own RSP, he contributes it to a spousal RSP. So what
Mhm.
that means is he still gets the tax benefit. He still gets the tax deduction for the higher earning spouse, which is great. But the asset, the spousal RSP, is in the spouse's name. So when it comes time for retirement, the spouse draws down on that income and it's their income instead of the higher earning spouse's income.
Okay, I've got one more idea for you, Tarek.
Okay.
If you're with a company that wants to give you a bonus
Mm-hmm.
and you'd like to split that bonus with your spouse, maybe the company could put it into a consulting company that you own. And then out of that consulting company, you can pay each of the spouses equally.
Yeah.
Works?
Yeah,
A
that
little
could
more,
work.
there's an
Yeah,
extra step there, but if there's a remarkable amount, it might be worth it. In that
it might be
consulting
worth it.
company, you have to have more than one type of income. Otherwise, it's just viewed as general anti-tax
So yeah,
avoidance.
and there has to be some demonstration that the spouse is doing something. There has to be attribution, like that they earned, right?
Okay,
But
good.
yeah, that's definitely a good way of thinking of it in terms of, yeah, let's keeping every person's income lower is better for your effective tax rate as a family.
Even better yet,
Mm-hmm.
call Tarek.
Exactly. That was what I was going to say. The CRA has a lot of rules. We make it sound simple, right? That's what we're supposed to do. But the CRA actually has quite a few rules. You can never split employment income, for one, right? So employment income, it goes to the person who earning that income. And then before the age of 65, you can sometimes split some income. sometimes not. There's a lot of rules. After the age of 65, you can split more. So RSP, RIF income, that's the big one. But honestly, if your situation, if you think this applies to you, reach out to me, reach out to Mark, and we'll put together a plan
Yeah.
that's specific to you and the various types of income you might be receiving and how we can make sure you're in the lowest tax bracket possible.
Yep. In fact, I will tell you that we have a client, hopefully someone who's listening right now, who wanted to make a charitable donation, and they called Tarek to trigger the donation, and Tarek went back to him saying, "Well, if you'd like to save some taxes, you could donate some stock that is in your account."
Yep.
And you ended up saving them quite a bit of money because
Yeah.
donation of stock generates a full charitable receipt for the dollar value, but it is not treated as a taxable gain. So your cost basis just stays low. There's no tax event causing taxes, but you get the full tax receipt,
Yeah.
charitable receipt. Anyway, talk to Tarek is the short version of all of that.
Yeah. And gonna toot our own horn here. I think that client said we saved them 70 grand in taxes or something like that. It was and that's going to be another, maybe tax strategy we talk about with donating securities in kind, but significant
Okay,
savings available.
let me go to I'm talking about now future videos. I think we're done with this, right, Tarek?
Yes.
We're wrapping up. For you to sort of whet your appetite and start the priming the pump for watching for what's coming next. We're going to do a video on what are our actual management fees. I hope you want to
Yep.
listen to that because I think we're more competitive than it might appear. That'll be another video. There's another one that, this charitable donation thing. Many of our clients, Tarek, are charitably inclined. We are working on developing a foundation in Tower so that you can transfer assets into the foundation. It's going to take us a couple months to iron that out, make sure it works well, but it's called a donor advised fund
That's
that we're
right.
going to generate within Tower. And we're going to unwrap that in the next, I would say by Christmas time, we'll be ready to do that.
Yeah.
Um,
It's a very interesting, I think it's going to be very, very, very helpful for a lot of our clients. Yeah.
and then you as clients can have an account that's your own, it's your investment account. You can have another account sitting beside it that's your donation account. And that money you can just simply call us and say, I'd like to give this much money to that account and to that client, that charity and that charity and that charity, and we'll handle that for you. But you'll generate the tax receipt the minute you make the donation, and it can all be
Absolutely.
done in stock. Okay, we'll come back to you, but thank you for your time. Are we done?
Yes. Appreciate it. If you have any
Wrap it
questions,
up.
let us know.